Good morning, everybody. It's Thursday morning, August 9th, and I'm coming at you from a sultry and hot 75 degrees on the beach, Playa del Rey, California. Dr. K, are you with us? You're at the Olympics right now. Have you been watching anything going on there as far as the Olympics go?
I've been pretty busy, but hope to catch some stuff on Sunday.
Okay, good. Looks pretty fun from here. Looks like one big party, so I kind of wish I was there with you. But in any case, we're here to talk about the market, not the Olympics. And the markets are kind of like markets a little bit like watching the gymnastics competition in the Olympics. You know, a lot of vaulting and you get some vaulting, you get some double whatever they call them, parallel bars action going on in here. Yes, it's pretty exciting and it's all over the place. But it is one difficult market to play right now. And of course, as we all know, we got a sell signal on the market direction model right here on the Nasdaq. I'm assuming everybody can see the screen fine. Can everybody see everything just fine? Okay, very good. Yeah, you may notice today I'm on a different computer. I'm actually using a laptop that's plugged in on a Cat 5. So came into the office this morning and the PC blew up. So the blue screen of death, that's why I wish I could get Apple machines to run my software programs, but we're getting there. We're getting there. In any case, you can see the chart of the Nasdaq. You know, we got a sell signal in the market direction model. Of course, that was a low, and we went to a neutral signal 3 days ago, and now the market's just kind of hanging out in neutral roughly, but it's run up. You're seeing a little bit of stalling. I think, is volume up today, Dr. K, or is it lighter?
Let me check one sec here. Last I looked, I think we're running about even.
So volume's running about flat. So, you know, you're kind of just kind of hanging out here, but it almost seems to me that you get these movements up, you stall a little bit, and maybe you're going to pull back again. But the big problem, I think, for us in terms of the market is the fact that you're not really seeing any convincing leadership move to the forefront. There are some stocks that are acting well, but it's just a very small handful, and you're really not seeing, you would think that at this stage of a movement up, of a rally, in fact, this is just a big confirmed rally, but it's a very choppy and zigzag-like formation here as this thing goes higher. You would think that you would see broadening leadership and just broadening breadth and things just looking better, but it's just kind of sloppy and choppy, and it's difficult to make progress. So our general take right now on the market is to be neutral. Now, as far as I'm concerned, as a trader and as someone who will sell short, some stocks rallying up into areas where they might be shortable that coincide with the market rallying in here. If this thing heads south, I think there's potential to make some money on the short side, maybe not a lot, but that's really going to depend on whether you got some big break to the downside. And I think something like that would probably have to be a news-oriented type of break. Either the Fed isn't doing anything, or they say they're going to hold pat until the election, or the ECB either does something and the market doesn't think it's enough, or they do something and it's a shock and awe type of thing, and the market takes off from there. But I think that's really what you're looking at. Dr. K, you got any take on this? What's your spin on the market right now?
Really, it's been sloppy and choppy, and there's no discernible trend at all. In fact, this is the kind of pattern. It's perfectly bad, if that's a phrase. In other words, we don't like trendless markets. 2011 was about I think as trendless as it's been on the Nasdaq, and yet it was profitable because there were a few moments where the window of opportunity opened up. There's a lot of volatility in August and September. The market direction model is able to make quite a large gain during those months. And right now, if the volatility were larger, I think the model would be either breaking even or maybe even up a little bit in this back and forthness. But and if the volatility were less than what we've seen, then the model probably wouldn't have taken the signal. So it's just exactly where it's hitting that resonating frequency. Call it a resonating whipsaw frequency. That the market has achieved the perfect resonating whipsaw frequency over the last couple months here. And this kind of perfection is not enduring, thankfully. But that said, the model does adjust in real time to different circumstances, and so there was a signal that the model issued, and it did not take it, and the model's going to have to see some more evidence of some sort of discernible trend before it gets involved in this kind of back and forth market.
Yeah, I mean that's pretty much where you're at. So I haven't really found the long side outside of trading very quickly, 2-3 day trades and in certain stocks when they're on the move. And let's go to a daily chart here. For example, I mean, you can trade something like a LinkedIn. You could have picked it up on the reversal coming up this day, right at as it comes above the moving average, and you get a couple of days, and then the thing just falls right back in. And I think that's what a lot of stocks are being plagued by, this sort of uneven action. This is coming straight up off the lows. I was noticing this morning Seattle Genetics, which is a stock that I have owned but sold before on these weak volume moves to new highs. Today came out, or actually last night came out with earnings. They got clobbered this morning, and the thing reverses to the upside, and just to make a really jagged pattern. And that sort of stuff is very, very difficult to deal with as a trader. What looks coherent here? Dix, we saw they were trying to break out the other day on this pocket pivot, and it comes up and it's going sideways for the most part, but really not going anywhere. You can see Brinker's International EAT is breaking out today, and the volume's pretty good, so what are you going to buy that one? Another one that acts pretty well is SolarWinds. It's coming in. You had this big gap up here. I guess this could have been bought, and it has drifted higher. You're running out of upside volume, but it is kind of hanging in there. But still, this thing violates the 50-day moving average a long time ago down in here, and it just keeps coming down. It looks like it's headed for the 200-day. Finds a little support. Let me get this out of the way. On top of this area here, this prior base back here, finds some support, and boom, you're off to the races. So, I noticed Ross Haber, who works with us, his approach in a market like this, and I'll do it a little bit, is not to buy strength, but to look to buy the strong stocks when they look ugly. And, Ross once co-managed the Affinity Fund at Affinity Capital, as a base in New Jersey, and this is from 2004 to 2009. That fund roughly doubled from start to finish over the 5 years roughly that it was run. And their approach there was to buy stocks when they looked ugly. They would look at fundamentally sound stocks or stocks that were leaders, but they would buy them when they would look ugly. And one thing Ross told me the other day is that he doesn't really pay attention to the 50-day moving average. He thinks that that's all baloney, and that when a stock breaks the 50-day, these days institutions know that a lot of people are looking at that, and they'll come in and buy it, and they would do the same thing. They're running $650, $750 million. They see something they like, and they'll come in and buy it when it looks the ugliest. We were looking at Zillow a couple of weeks ago, last week really, towards the beginning of the week, when it actually violates the 50-day moving average in here. This is one of those volatile stocks, but this isn't looking so great. And Ross is looking at buying it in here. Of course, you get the 3-day move, boom, boom, boom. So you buy it on weakness, boom, you get the 3-day move, and then that's it. And we break down yesterday on earnings, and the companies announced that they're going to do they have a shelf offering, but no specifics really on what it's going to be, stock or debt or what, and who's selling. But it's still, it just kind of points out that you have to kind of take a counter attitude towards the market, or a counter strategy, a contrarian type strategy. But is that really going to lead to a big uptrend, or are you just playing the market like a big oscillator? And we know that the market direction model has acted pretty much like a big oscillator, and you know that for sure. And of course, we don't, there isn't some council where we sit around during the day and decide what the signal is going to be. The market direction model is based on certain criteria that were back tested historically, and it's an objective signal for the most part. So it's not like anybody's making up the signal, but you do know that it's not really cutting the mustard right now at all. It's flailing for the most part, for lack of a better word, and that's kind of what's going on. But if you know that, you can adjust accordingly, I think, and that means if you do get a sell signal, for example, as we did the other day, last week, down in here, and look at it's right above the 50-day, and this is something in my thought process. So the thing is, don't take a big position and limit your loss if you get pushed out. And of course, it does break out, and here we are hanging out on the Nasdaq. But you can use a little bit of logic, because Even though we got a sell signal here, it's near the 50-day, possibly, you know, logical bounce. And what seems to happen is that the market will drift up on light volume, and as soon as the volume comes in, and actually let me switch this. Let me get a new chart up here. We'll change this to NASDAQ, and we'll just make it a gray chart. So, and you can see if we look at the NASDAQ, let's go back here. Did I get that right? This is a grayscale chart. This template actually is left over from when we wrote our first book, and the computer I'm using now was actually the workhorse for the book at the time. And we use these, but you can see, you know, you get 2 days off the bottom. Here's the you get some support here, a little bit of volume. The next day you gap up on no volume at all, and then here's where you start to see some volume come in, and it seems like the volume comes in at the inflection points. You know, like even back here when you rallied up here, and you get some volume, you finally get some volume at the peak, and then it comes in. So it almost seems that there isn't really any conviction either way, but if the market starts to move in one direction or another, money is forced, and I would say institutions are like this because they have to keep up with the S&P 500 or whatever their performance bogey is. Excuse me, and so they're forced into the market. So when you hear people talk about, you know, it's the pain trade, that every time the market ticks higher, you know, that people are painfully buying into it because they have to, and institutions have to, and that will drive it up on light volume. But at some point, you can run into some resistance if you don't see, say, a blossoming of the underlying conditions that you would want to see for a bull market. So, you know, usually a new bull market starts when the Fed starts lowering rates, and you know, we're already at 0 interest rates, and I'm not sure what sort of catalyst triggers a really big secular bull market, although I think that's possible in the coming months. But it may be that we need to go through a little more downside. To me, this rally just looks like some sort of big ascending wedgie type thing that could be setting up a break to the downside, but you don't know for sure. So I really don't trust this market, and I play it on a stock-by-stock basis, and basically look to play the market that way. So just as an example of what I've been doing, we shorted Intuitive Surgical this morning. It blipped above the 50-day moving average, just in a wedging rally. So this has broken down huge selling volume, so you know institutions are leaving. You have one test of the 200-day moving average, and it comes off, and then the volume lightens up on this rally, and there's a second one. Now, I don't know if it pulls back and tries again, or if this goes on for a period of time, but I think if the market pulls back more, you're going to see this test the lows, and so on that basis, I'm willing to short the stock and take a position. Another one that actually shorted the day of Priceline's earnings on this day right here is TripAdvisor, and this is, you know, big, massive gap down, big volume break off the peak. So to me, this thing is topped, and I kind of look at this as a left shoulder, and this is your head. Now you're forming right shoulders. So it seemed logical to short the stock here, and I also thought that with Trip having this sort of, you know, doji sort of day, or this kind of abandoned baby, or whatever you want to call it, it's just wedging up and stalling and churning up here, maybe in anticipation of Priceline's earnings, but you're kind of thinking through what might happen. Priceline to me looked like it was getting a little bit too funky, and so I thought I would play Priceline's earnings by being short Trip, which is kind of on this what I call a stretch type of rally, where it's just kind of stretching higher, but no real volume. Expedia was another one I shorted into on this day here, just because it looks similar to Trip, so I just forgot about the fact that it's in an uptrend. And you know, the stock breaks down 7, 8, 9, 10%, so if you're running 100% positions on each, like I might be doing, you're going to pick up 6, 7, 8% pretty quickly, and that's one way. You know, it's mostly tactical though, and I'm not sure whether, you know, maybe Expedia doesn't break down, but I think maybe Trip has a better shot at heading a lot lower, so this might be the one I decide to stay with. But you know, that's basically all I'm seeing. There's a few things out there that look shortable, such as, you know, F5 on this kind of weak volume rally. You're up in here. I don't know if it's rounding out a base is going to go higher, but this might be where one looks for some sort of weakness to come after the stock, and of course it has pushed everybody out at the 50-day moving average. So, you know, there's that. And TIPCO is another one I've been looking at. This is very jagged action, but it basically comes up. There is some I think VMware the other day bought some company that allows for data tracking, I guess, and it says that VMware now is competing roughly with TIBCO, but it was seen as some confirmation that this area is hot, and I think it moved up on light volume through the 50, or rather through the 200-day moving average here, and it goes a little bit past, but you can see it's every time it's done that, it's rolled over to the downside. So, you know, shorted up yesterday around 29 as it gets up to this sort of declining tops downtrend line, and it rolls back over. Now, if it breaks down through the 200-day and the volume picks up, I'm probably going to come in after it again. But this morning they did have it up a little bit, so I did put out some there. You know, and so that's really what we're looking at. If the market breaks, yeah, I'm going to be in Fat City, but it's not really clear that this isn't just going to turn out to be a short-term 2 or 3 day trade, or that I would get stopped out if it moves up to the 29 level, which I would keep my stops on pretty tight. I mean, the other day we were trying to short it right about the 200-day moving average, but it kept going past. You just cover very quickly and let it rally, and then go after it again, or you know, add to your position depending on how you want to handle it, because we know that these things can go 3 to 5% past a major moving average. You know, like Ross likes to say, these moving averages are bunk, and he's somewhat cynical about it, but you know, he's come from the big money institutional side, and he knows how a lot of these guys think, and yeah, I think that's true, because you do see a lot of swishing back and forth above and below the moving averages, and this is definitely one case. But you know, could just be a function of the market itself. And once we get into a smoothly trending market, or a more smoothly, or let's just say a somewhat remotely coherent market trend, that we'll start to see stocks act better as well, and less volatile, because obviously the volatility in the market is the volatility in individual stocks. Anyways, that's my 5 cents. But you know, a few other stocks I'm looking at. You know, Apple, nobody's really buying the breakout, but nobody's really selling the breakout, so it's hanging in there. I just wonder what sort of catalyst would cause the thing to break out. Today some broker came out and put I think it's an $825 price target on the stock, which is you know, about 30-some% higher, and it didn't really engender any real big buying in the stock. It's still sitting here on low volume, going nowhere. Of course, we know Priceline got its head handed to it, and I was on Fox yesterday morning to talk about Priceline and McDonald's, and of course Stuart Varney just can't understand why someone wouldn't see this as a bargain and want to buy these stocks. But of the three, I remember I said I like Disney, and of course, you know, it's in a nice uptrend. Not that I would buy it, but it is acting better than McDonald's or Priceline. And I think this is just a company that's able to manage their way through a weak global economy, whereas Priceline and McDonald's are really telling you that things aren't so hot out there, and things we may be heading into another down leg in the economy. And if that's the case, in fact, some economists claim that we have been in a recession now for the last 3 months or so. For most people I know who have real jobs, it still feels like they never got out of a recession. And I know most of the people I know are unemployed and have been so for the last 2-3 years, particularly in the financial services business, our business. They haven't found any jobs, really. So for them, the recession has never ended, and you're seeing this, I think, in some of these stocks. Let's see, other big names. Let's see, Amazon's been hanging in there okay. And it had broken out, but it's not really that fast. But it's holding in there. I mean, it's not breaking down. It's not really going anywhere either. I noticed this Pacira Pharmaceuticals getting a little pocket pivot type of gap up move here. And we've been watching this for a while. We actually wrote about it in a MarketWatch article about some of the biotechs that we liked. And this is one of them. They have an alternative pain management therapy, which is not Vicodin or some of the other addictive painkillers. So it looks like they're getting some play today and some volume, and it is a thin stock, though, but that's been acting okay. Let me see some of these other ones. PCYC, Pharmacyclics have been a real hot one. Looks like it had a climax top. Sometimes these things look like they're climaxing, but they don't really. You never really had a big one-day price move. You know, usually a climax top happens after you have a big spike or a big point move. And what we see now is the thing's kind of trying to set up. Almost looks like it's setting up in a little flag formation. So I'd keep an eye on that one. I definitely like the story there. Affymetrix also, or Affymax, right? I keep thinking of Affymetrix when I see that one. It had a pocket pivot here, but it's a little bit V-shaped, so it does pull back in. It's still in the flag, and I don't really see this as being actionable. So let's go through some of the questions today. I know we had Dr. K earlier. You were sounding a little bit warbly. I don't know if that's coming from your end or my end, but we are taking stopgap measures today. I'm on this what I call the latitude with attitude. This is a very high resolution screen, and I use this for charts for the books, and we have to bring it in, call it back into duty for today's webinar. So let's see some questions. Somebody asks, when you check the volume, is that compared to the day before or to the average? Well, I would say both. So, you know, but to determine whether something is a distribution day or a follow-through day has to be on higher volume than the day before, and a distribution day has to be on higher volume than the day before. So in that case, it is relevant for the averages in terms of determining follow-through days and distributions. On stocks, you know, that's neither here nor there necessarily, because a pocket pivot doesn't necessarily have to be higher than the prior day if the prior day was an upside volume day. So, you know, there's it should though be, and it doesn't even have to be above average, you know, so breakouts should occur on above average volume. But for the most part, indexes to determine distribution, follow-through days, you're using a comparison to the prior day. And stocks, more often than not, you're looking at pocket pivots where you want to see the volume higher than any down volume in the pattern over the prior 10 days. Or on a breakout, you want to see it much higher than average. What do you think the rationale is for the ECB's reverse operation twist? So basically, I think the Fed was selling the short end and buying the long end. So they want to drive down long-term rates, and since they're already sitting on top of short-term rates, those go nowhere. And essentially, you're just driving the yield curve. You're flattening it. Now, the ECB wants to do the reverse, where they're going to sell the long end and buy the short end to drive down short-term rates to make it easier for countries like Spain and Italy to borrow money on the short term to fund their you know, overspending habit. And so that's basically what they're doing there. What is the rationale? The rationale is to make short-term interest rates more palatable for countries like Spain and Italy so that they can borrow short-term, and hence that solves their short-term cash problems. Right now, Greece is basically in a big cash crunch. And last week there was some, it was kind of a quiet bailout. There was some money released to them, but they have to adhere to certain economic and austerity measures in order to qualify for further bailouts. And so far, you know, it's just impossible for that to happen. So I don't even know how they get out of it. But I think, you know, the whole strategy here of driving down short-term rates in Europe, that's what it's designed to do, is make it easier for countries like Spain and Italy to borrow. Now, I heard Mario Draghi, and this is something where politicians are really full of baloney as far as I'm concerned. He says that the fact that Germany has low short-term rates and Spain has high short-term borrowing rates indicates that the markets are malfunctioning, or it's a dysfunctional bond market. And that's baloney. In fact, the market is functioning as it should, because what moron in their right mind would loan money to Spain without demanding a high interest rate, whereas Germany, on a relative basis, keeps their fiscal house in order and they're less of a risk, and so obviously they would, their debt would command lower interest rates. So the market's working perfect. It's the politicians who are dysfunctional, or rather malfunctional. So that's really the point, you know, about what the ECB is doing. Our Fed wants interest rates to remain low, while the ECB wants higher long-term rates. Well, yeah, I just explained that. So somebody's asking about Tango. TNGO, you know, doggy. It's a Volvo stock. Any take here, Dr. K?
Looks like it had a good earnings report, had a mini gap up. It's a sloppy pattern, so it's not the kind of stock that I'd be involved in whether the market's the way it's been or even in a good market. This stock doesn't excite me. It's also on the smaller cap side, so I would avoid a stock like this. In this kind of market environment, you want all the ducks in a row, and that means one of the ducks should be a stock that's not a small cap like this one.
Yeah. I don't really care for it. Somebody's asking about AZO as a short. I think AutoZone It looks to me, here's your breakout here. So you failed and you broke down through the 50-day moving average, and this is like a late stage base. If we look at AZO on a weekly chart, it's been going for a while. So you got this kind of like, three waves to the downside. I don't know if this is going to be a bottom or not, but I think it's shortable if it rallies up into this area, which is around in the 370 or 375 area up in here. But it is finding support along this level down 355, 360, and so I think it's shortable up here. But like I said, a lot of these shorts I find are just short-term trades of a couple of days. If you had shorted AutoZone up here, boom, you could have gone down 200-day moving average, and that's 15 points or how many percent? 5% max, if that. And then it goes through the 200-day. Now we're turning back through it. So, yeah, I don't know if I'd short it right now, though. Here's a question for you, Dave. Dr. K. Apple, let's see, Apple, Google, Amazon, big leaders near new highs, market hitting new highs. MDM goes to cash at new highs. Seems Dr. K is switching to overbought, oversold from trend following. What's your response to that?
Well, like I said at the beginning of the broadcast, this kind of market environment, if you look at the NASDAQ, and it's just perfectly choppy, so it goes just long enough to where some leading stocks and some other metrics look like the market's going to finally pull out of its choppy sideways pattern, and then some bad news hits out of Europe, and so then it gets shut down for a few days. And then some politician comes out like Draghi and says, okay, we're going to make sure that we rescue the markets if we get any crisis situation, so the market then rallies on that news. And it's just a ping-pong effect. It's a perfect ping-pong market. I'd be hard-pressed to actually see this kind of perfect kind of volatility, where the volatility isn't massive and it's not small. It's just in that perfect perfect zone that creates this ping pong effect. And if you go back to 1999, second and third quarter, it was more volatile and rocky, and that was a different type of pattern altogether that the market has never seen before or since. But that was perfectly bad. Perfectly horrible for the market direction model, which is why its biggest drawdown actually is in the second and third quarter of 1999. And this kind of environment is it. Sorry?
So I'm going to see if I can take the chart back there. So here we go on the time machine.
But basically, what we're seeing right now since June is a perfect oscillatory market. The oscillations are just wide banding enough to create problems, and therefore, as we've advocated, keep your position sizes small and let price prove itself before you add to your position. I mean, there's nothing wrong with pyramiding an ETF, especially when the market seems fairly directionless like it has been. So that's to say that you could get hit with, say, 5 false signals in a row, and if your initial position was pretty small, then that's all you're losing. You're just losing your initial small position 5 times in a row, which maybe that makes up the equivalent of 2 false signals instead of 5 false signals. And again, there's a fail-safe in the model, but when the market's like this, the fail-safe widens to avoid getting whipsawed. Unfortunately, the width of the market, the banding, is just perfect enough so that the fail-safes are really not working in this kind of environment. So that's all to say that if this kind of repetition if this were to continue repeating for another month or two, the model is not going to just sit and get ping-pong back and forth. We're going to have to see some greater evidence of market direction in either north or south before the model gets out of its cash position.
Okay. Yeah, and here's you can see the first 2 quarters of 99. You can definitely see this crazy volatile action, and we were pretty frustrated, I think, by this point. Right here, this is where Bill, I think, told me that the market was done and it's through, and of course he got whipsawed too, so and then we started a big trend higher. So Dr. K, this isn't the first time the market direction model has had to deal with this kind of volatility. I will say one thing.
90
go ahead,
was 70. I think it was 77. The models had 2 down years, and that was 2007, and I think it was 1977. 1977 was just pretty much flat and go nowhere. And so, you know, there really wasn't, the model kept getting false signals and getting chipped away. The fail-safe was actually really tight on the model because the volatility of the market was low. Nevertheless, the model was down. I think it was down like 1 or 2% for 1977. But then in 2007, you had a lot of cross currents going on, which created abnormal price volume action. So you had a lot of distribution days clustering together, causing the model going to a sell signal, yet the market would then get back on its feet and go to new highs. And that created a string of false signals in the model in 2007. So 2007 was its worst year. And I think the model was down something in the neighborhood of 8 to 10% in 2007. Other than that, the model's been up every single year, and generally over market cycles, it's always beaten the general markets. You know, in this latest cycle, say this latest cycle started in 2009. 2009 to 2011, the model did, you know, fairly well. 2012, it's been really tough, and again, these tough periods always come to an end. The market's not going to just ping pong back and forth over and over and over again. that would be pretty amazing and pretty coincidental. But nevertheless, the model does take account for that. And so, not like a period like the second and third quarter of '99, the model slowed up its signals so that it would, you know, in other words, it took its foot off the accelerator coming into the end of the third quarter of '99, and you know that's really what it has to do here. And just kind of wait and be patient until the window opens again, which it will. We will always get a new trend, so it's just a matter of when.
Yeah, and that's pretty much the story. You know, the market direction model is what it is. So, and it seems that we have gotten rid of all the psychos who would send in emails lambasting you, Dr. K, as if you somehow do it on purpose and you create false signals on purpose, and somehow you're profiting from your false signals while other people are losing money. But that's not true.
I only saw a couple of those. I mean, I seen you send them to me because I've only seen just a drop in the bucket, really, compared to our huge user base. I mean, I guess those are the ones we're going to remember, though, because we could get 90 good emails and one bad one, and we're gonna remember the one bad one. But yeah, I remember there was one. Some guy said, "Well, enough of this. If you guys aren't going to share your internal secrets about I don't know, something about our day trading." You know, our very short-term, intraday signals or something like that. And I'm thinking, well, wait a minute, those signals are not actionable, they're not practicable to most people anyway. I mean, I can barely, I often miss signals from my own, internals when it comes to this intraday stuff. If I'm not on top of it, literally at the click of a button. So I don't see how, it's not actionable to people, to other people. It's not some, it's not like we're trying to hide this from people. It's just a matter of practicality.
Right, and also for $59.95 a month, I'm not giving every secret away in the house, so ain't gonna happen. Let's see, FTNT is trying to come back. It just needs some time to build a base. Maybe it's a cup, maybe it isn't. So, but I don't have any comments on it. Here's one for you, Dr. K. When the index's 200-day moving average flattens, do the markets in general usually chop up and down for a while? If so, do you have better odds to make money using 60-minute charts and swing trading? I think that's kind of what we've been talking about. But Dr. K, what's your take?
Yeah, I wouldn't. I would say that when the 200-day flattens, that's usually not a good sign. It often does presage a turning point or a sideways choppy band. Sometimes what happens, I hate to use rules here because there's so many different situations. In some cases, flattening of the 200-day usually means a really rough storm ahead, and you're going to go into a bear market. And the markets, especially as the major averages go below the 200-day, what you start to see more volatility, and then as the market gets pulled down lower, there's a lot of money making opportunities on the short side. So a flattening of the 200-day can actually lead to profits on the short side. It can also mean a prolonged flattening where the market really doesn't have any discernible trend. And so that's another possibility. I mean, I'm looking at the S&P 500 right now, and I'm looking at a weekly, and if you look at the 40-week, moving average, which is the equivalent to the 200-day, what you see is, since 2009, what you see on the 40-week moving average is you see a flattening after the May 2010 flash crash, which this flat 200-day moving average then persisted for about 5 months, and that was a very difficult period, if I'm sure you all remember, and that is when the market direction model, because of the unpredictable nature of that environment, the market direction model has a rule that does not take buy or sell signals, certain buy or sell signals. So it actually foregoed a number of those signals to its advantage, so it was able to actually do fairly well during that very choppy time when it should have been whipped around. Now, if you look at if you compare the weekly of that period, that is May through about September of 2010, you can see it's very volatile and very choppy. So the model has signals that say, okay, we're going to stay out or not take all the calls, all the signals. Now, if you look at the weekly recently, you can see that on the S&P 500, it's a perfect band, slightly upward drifting, but it's a perfect band of volatility. Not too. It's like the three. What is it? I'm forgetting my childhood tales. Little Red Riding Hood. It's not, the volatility is not too great and it's not too small. It's just right. But that creates for some serious ping-ponging effects. And again, if you look at the weekly on what's happened in the last few months on the S&P, it's very difficult to find a time when the S&P's behaved like this. It generally doesn't like to behave like this. It generally will find a trend upward, downward, or it will go sideways in a choppy fashion. And so, again, this is a very unusual circumstance, which is why I'm not terribly concerned about the model. As long as I know why the model's losing money, I don't lose any sleep at night. So and this is a perfect example of where the model is going to have trouble. But again, it's not going to be taking every single signal because this banding effect, the market has to show some evidence of moving away from this before the model actually switches out of cash.
Yeah, it looks like you had a lot more volatility on the weekly chart of the S&P back in the summer of 2010 and last fall. So the market really now seems less volatile than it was back then. Yet, I remember last year the model hit all of these inflection points just right, whereas in this less volatile area, it seems like it's catching them at the wrong end now.
Right, and what you'll see is, again, if you look at this kind of banding, it's very, very rare to see this kind of example. And so, the model, I guess you could say this is a new one for the model, and so, the parameters that it goes by, the market's going to, like they say, the market's going to serve up every single possible challenge you can think of, and this is a new challenge. But these challenges, again, they don't last forever. They always come to an end, and the market goes into a new dynamic. So, it's just a matter of being patient and keeping your stops tight and your position sizes small. And I would still recommend that for the next, when the model does have a change in signal, I would still recommend keeping your position sizes on the small side and let price prove itself before adding to your position. That way, if we get yet another false signal, you're not going to lose very much money.
All right, let's go to some more people asking about stocks. I don't know. What is there to think about this? It's holding up. It's one of those stocks holding up. For all you know, it's the next one to break. So I don't really care for the volatility. We've talked about this one many times. So this one's also acting okay. So the space, this one's actually better between the two. I'd rather own this one, but it's so thin it doesn't even hit my radar in terms of being tradable. But between the two, SSYS is better, I think. 3D is very volatile and not really something I care about.
Yeah, you don't want to get, in this market, there's been a lot of these stocks that, I don't know how the markets are made in some of these stocks, but you get these big drawdowns, intraday drawdowns, and that increases the risk massively in holding such a stock because you're liable to get whipped out of the position. So, it's another good reason to stick with better capitalized names. So that would mean names with market caps generally above, $2 or $3 billion in this environment. and
Yeah.
SSYS doesn't quite make it.
So I should point out that today I believe we have the youngest webinar attendee that we've ever had. 8-year-old Angelina is online with us today, and I think that's great. Tim, I hope that she is learning about the markets and understanding how charts work, because I think there's no better way to empower a kid than to teach them about the markets. My kids will watch me trade, and my son actually makes a lot of interesting observations. He's 11, and he's getting to the point where he's probably going to start bugging me for his own trading account. But Angela, I think it's great you're listening, and welcome. So it's great to have you. Young blood is always good blood, and for old farts like us, we can definitely use that energizing influence. So, anyways,
Yeah,
but
at that young age, it's like the brain's like a sponge. The younger you are, so it's going to have
yeah.
such a dramatic effect in the years to come. Especially, if the younger you are, the more interest you have in something, the more you can apply it later on.
Yes, and we can all apologize to Angelina for leaving her generation a really messed up world, and hopefully her generation will be the ones to figure out the solutions. So hopefully she's paying attention and learning things, and she can apply her knowledge to solving the problems that her generation will face, and that unfortunately were caused by the generations before them. So, but don't get mad at your dad. He's still, I'm sure, a good guy. In any case, in Vensense, you have this bottom fishing pocket pivot, but I'm not really inclined to buy it, mainly because it's not a big leader, and it's got a lot of overhead to get through. Maybe it can rally up to 15. I think when we saw this, we thought it might be able to rally further. But the thing is, are you going to get a big trend? Is it playable? I would rather see it set up in a base. I'd like to see earnings growth turn positive rather than be negative. So
Yeah,
when we are
don't be
not in
tempted by these
correction,
kinds of names because they looked hot at one time and now they've broken down. And I mean, this is just the odds are really stacked against you on a name like this one. And I know it's tempting to play, especially when you see good technical action off the bottom like this one and a good earnings report. But again, I mean, I don't know any market environment where I'd want to play a name like this with this kind of chart pattern. I mean, it was playable once upon a time when it had a pocket pivot in January of this year, and it was a beautiful play. And that's it. That's what happens with a lot of these names. Even in the 90s, I remember there were a lot of when I was going over my trades every semi-annually, you look at some of these names and you made a lot of money in a brief amount of time and you never played them again because they were not playable after that first go. And in Vensense, it might be another one of these very these casualties.
somebody's asking, if we're not in a correction, why are so many looking for shorts? Nobody's really looking for shorts. And interestingly, I only have one short question so far on AZO is that a shortable stock. I showed some ideas that I have on the short side, and there are some potential trades on the long side. But as I see it, either way, you're playing it on a stock-by-stock basis, short or long, and seeking to 2 or 3 day trades max. I know that's not really the trend following method we want to use, but that's all there is if you're a trader really in this market, as far as I'm concerned. Somebody asked about TLT. Short or long, I mean, it's just bonds, so I don't really pay attention to this either way. So maybe if European troubles pop up, I think it's all news oriented, then you'll see treasuries become a safe haven, you'll see it rally. The same thing has been going on with the dollar, so the two kind of been moving together. If you notice, the dollar's come off sharply too, and what happens here is that when the dollar or rather when European troubles crop up in the news, everybody runs to the dollar, and that's what happens. And when things seem to be settling down in Europe, then the dollar rallies, and that's been the case over the last 3 days. And it's kind of moving back to the upside with the dollar and TLT, or rather to the downside. What am I saying? And the bonds are doing the same thing. So I'm not buying or selling. Is MNST shortable? Oh, if you listened to last week's webinar, I thought, what are my quotes? I thought that MNST was probably going to test the 200-day moving average. It actually went through it yesterday after hours, but it looks like it's headed that way. The shortable gap down maybe, so you could short it using the high today as your stop, but I think that's still a short-term trade to the 200-day moving average, so you'll get 5%. Dr. Kate, I'm going to put up the VIX, and I'm going to run to the little boys' room real quick. And people are asking about, whoops, let's see if I can type this in right. VIX, whoops. See if you can talk about what's going on with the model. I'll be right back.
Sure. So we've got, I guess that question is about the UVXY TVIX model, and it's ready to go, but in this kind of, it's a shorter term model, but at the same time, this is not a market friendly environment for really most models, shorter or longer term. The UVXY model will be issuing signals when it sees the next signal. I guess that's the best way to put it. The VIX, of course, is one variable there. The model does not. The model uses the VIX, but in more of a broad brushstroke. It's really looking at other variables. Don't assume that UVXY, TVIX, VXX, or any of these ETFs or ETNs are going to correlate with the VIX over more than a few days. In general, they won't. On a day-to-day basis, on the other hand, there is pretty good correlation. So if the VIX is up on one day, if it's up 6%, then you can bet that the others will also be up as well. As far as certain issues within the VIX, when the VIX gets away from its 10-day moving average by a certain percentage, typically in the teens, that often is the prelude to a market downturn. But again, these are statistical rules that the model is ingesting that have shown to have statistical significance over many years, over a number of market cycles. So at any rate, the model is dormant for now, and it's awaiting the next signal. The next signal, like I said at last week's webinar, will occur any time between a day from now and I would guess probably two or three weeks from now. So a signal is imminent.
Okay. Oh, I like this. Somebody says the MDM is racist, says a liberal. It is racist. It works against, I don't know who it works against. Working against me, so it's obviously racist against Hispanics. Dr. K, you're half
racist
Asian,
against these trendless go nowhere markets. It hates trendlessness.
Okay. Yeah. Somebody says they enjoy our pre-market morning emails. Good. We're glad you do. We actually decided to start doing that on a regular basis because we kind of put together a picture in the morning. I think it's helpful for people to know what we're thinking about. Hopefully it helps. But a lot of times too much information can be just that. Do you pay attention to the short interest rate on the NYSE? It seems it is very high. Well, that's one thing I'll look at from time to time. And in this kind of market, I've noticed when the smart money on the NYSE is going short, the market can come off. So it's not really a be-all, end-all indicator. And I think if you're seeing that increase into a rally, then it might be smart money putting shorts out, or the big money on the floor, wherever else, institutional money going short. And so I think it's contextual. I don't really use it as a primary indicator. How about you, Dr. K?
It's not something I use. It's just, again, it's one of the many secondary indicators out there.
Somebody's asking about Alltech. I think that's what this one is. A-L-L-T. No, A-L-L-T. Let's see if I get that right. Or is that, hold on a second. I think it's Allied Communications. Whoops. 2B shape. That's not a pocket pivot. You'd have to have higher volume than this day, and that's going to take a lot. So I don't really see that happening. The Oil Services Index, OI, no, Owens Index, sorry. I thought that was OI. Is that what you're talking about? I don't. That's a dog. I don't know. Is that a short? Maybe we're looking at that as a short. Let me take a look here. Whoops. Let's see here. I'm going to get a bigger bar so I can grab these turkeys. Owens, Illinois. No, I don't know. I can't really tell anything here. It looks like a dog. Maybe it just goes lower, but I have nothing to say about that one. HMSY is HMS Holdings. What do you think, Dr. K? I'm not really going to buy this one. Low volume, moved straight down, straight up, and low volume. At least it's got to go sideways, I think. But it's acting okay for now.
Yeah, the earnings on this thing aren't real impressive. In this kind of environment, I want all the ducks to be in a row, and other things about this stock look great. I like the revenues, institutional sponsorship. It's got a lot of good things going for it, actually. However, I just don't like where the earnings are going right now. So, you know, in the overall pattern, it's okay. It's okay. But if the earnings were better, then I might be more interested.
Okay, good enough. Yeah, CF is breaking out today, and you know, this has been a little bit choppy. It's moving higher. Uh, it actually came straight above the month, so it took some time to settle down, but it's starting to move and break out. I noticed that other AGU, I think, had a pocket pivot, actually a Bible gap up here. Of course, that failed right away. It's very choppy. So these things tend to be pretty choppy. CF, am I going to buy it? I don't know. You like it, Dr. K?
Not enough to buy. All these,
Yeah, I mean,
chemicals of these agriculture companies for the fertilizers, you know, they're very choppy in their trade, being commodities, and again, in this market environment, it's very difficult to play these and be able to hold on to them.
now, what you might consider is, you know, this method of buying when they look ugly like this. You know, this thing's breaking down, but it's really finding support at the price. You're right around 190. I'm going to say that price level 190 and maybe a little higher. And so you know, it's kind of the way this market works. You're probably better off trying to buy it when it looks ugly on a pullback, and then trading into the or trading out of the move higher. So you know, it is breaking out, and you have seen strength in AGU, and Monsanto also has been continuing to trend higher. I think we talked about this when it broke out. You know, again, it moves up, pulls back. See this kind of action. Bible here, and then it just kind of chops its way higher. So a little bit like the market. But you're seeing some of the stuff stocks act okay, and I think you have been seeing some oils act pretty well. In fact, I'm surprised we haven't got any questions on oils. OII, okay, not OI. Sorry about that. Yeah, there you go. There's Oceaneering. That's what is that? Oil services. Yeah, field services. So you know, it's coming up the right side of a cup, but you know, it's pretty much straight up from the bottom. So it's going to have to go sideways in here and build a base. But you are noticing, you see ags, you see various commodity related stocks are actually doing better on balance, and so there is that aspect to the market. So maybe it is anticipating QE. ESRX, I saw that one had a big gap up yesterday. That was probably a Bible gap up. Out of a cup with handle. Dr. K, did you mention this one or not? You didn't think it was playable?
Yeah, I mean, it's a pretty good stock. I would just, you know, and I'm just really picky about recommending certain stocks in this kind of environment. You know, it's not a bad stock at all, and that one, you know, it had a good earnings report, and you know, let's see if this works in this environment. You know, the weekly pattern doesn't look too bad, you know, but you know, these are the kinds of stocks, and this is the kind of market environment where I like to see a stock. Let's say this thing pulled back on lower volume in a constructive way, and that was in the face of, say, a down market, a weak market. That would show that's relative to the market. That's another sign of strength in the pattern. And then I would like to see maybe a pocket pivot from that point on, and then you know, become a recommended stock at that point.
So you would say, let's see, this one, figure a 59.50 breakout point, and 5% up from there is you just passed extended a breakout point, so I guess a pullback. But you know, this type of name, what it strikes me is in this environment, institutions will gravitate towards names that have steady growth, and so when the perception is these guys coming in with 24% earnings growth, I think it was yesterday, and that's what caused the gap up. So you know, again, you're kind of playing earnings roulette more than anything, but you could have bought it in the morning if you wanted to. I saw it, and I didn't really buy into it because I know ESRX, and it's never really thrilled me. It's never had any great moves in it, and it tends to be more defensive. But you know, that is working, and I think today you had an upgrade and a price target increase to 68. So the stock is seeing money come in. I think when institutions are having a hard time finding things to buy, this can definitely gather some favor, and that's definitely what's happening. But you know, if you wanted to buy it, I think I'd look for a pullback closer to 60 from here. Do you have any thoughts on Dow theory with transports diverging from industrials? Well, let's take a look at this first of all. So here's a transport index, and it's going down, and here's the Dow going up. I do actually think that that can be a problem, and that's been going on for a while, though. So the market's been going higher, so you can't make any pat decisions based on that alone. But I do think when the transports, which are considered economically sensitive and indicative of economic strength, when the trannies are trending lower, well, and this is kind of chopping its way lower, while the Dow and the rest of the market's going the other way, that's usually not a good sign. And so when I think you're seeing, that's one of the reasons I'm a little bit skeptical of this rally here. But it has kept going, and you're really at a point right now where I think you have to inflect the downside. This is another reason I'm not so bullish right here. So I look at it, but a lot of times the trannies can underperform for a period of time, but you might expect that they'll catch some wind, so to speak. So Dr. K, any take on that yourself?
Yeah, what makes this market tricky is if you look at back to January and February, the trannies were they were lagging the Dow Industrials, and that first quarter there.
Here.
And yet the market just kept going higher relentlessly. January, February, March. I mean, the Nasdaq and the S&P, they just kept going up on QE fumes, and there was really no leadership except for Apple. I mean, it was almost a one-stock market, which makes that rally that we saw in the first quarter of this year really bizarre by any historical standards. Again, that's another aspect that makes 2012 particularly challenging. As as years go, we thought people were saying 2011 was the most challenging year, but I'd have to argue that 2012 is turning out to be perhaps the most challenging one. But again, opportunity sometimes is right around the corner. So we keep our axe to the grindstone here, because that opportunity can sometimes materialize literally in a couple days. Or in the case of October 1999, I think it was about 3 days from the time Bill said that this market is finished to the time we were already loading the boat and buying up the best stocks showing themselves.
All right, we're getting towards the end of the hour here, so I kind of want to wrap things up. PPR, is that what that is? I guess so. I don't know. I don't really care for this. Prime rate. What is this?
That's a prime rate
prime
trust.
Rate? I don't know. Is that can't be the right one?
No, that would be
AIRM. Someone's asking about. That doesn't seem to come up. Is that right? AIRM. That's what it looks like.
That's right.
Here it comes. Air methods. It's a little. I mean, it's moving higher, so there's not really much to think here. You got a little continuation pocket pivot, somewhat extended off the 10-day here, but it's acting okay. And Alexion, I gotta think Alexion's getting long in the tooth. It broke out, and if we look at a weekly chart on Alexion here, you can see that it's been going for a while. So you broke out from here, you run up, and you're holding in. So I just wonder if it's going to be ready to fail at some point, but it continues to act okay. I know that Contrafund has had a big position in this for a while, but so far it's holding up. So if you're just operating on the basis of some basic selling rules, and I think you're sitting in some stocks if you have a low cost basis. Somebody says, I think most of us are can-slim type traders, and buying when a stock itself sort of goes against that. It's true. It's against your psychology, but I tend to like to look at strong stocks and then buy them when they seem to be coherent on the pullbacks. So, can one discount or ignore the volume and price spikes and spinouts in a stock that was affected by the Knight Capital glitch on 8/1? CWPI. Well, there's a few of them. I know NetSuite had a spin out, and Watson Pharmaceuticals had a spin out. I think that you would tend to just kind of, forget about this because it was caused by an electronic trading program run amok. So I think you could do that. You think so, Dr. K?
Yeah, absolutely. If you understand what caused that huge intraday move, and it's a one-time event, of course you just you can just basically override that. So it
Yeah,
doesn't. In
I
other words,
think
that's just to say it doesn't hurt. It doesn't hurt the chart pattern because you notice a one-time event.
somebody asked, what do you mean when you say 20% position or 90%? Well, figure if you had an account, let's say your account was 100,000, a 20% position would be $20,000 worth of that stock. 90% position would be $90,000 worth of that stock. If you're running full margin, you might have two stocks at 100%. So basically, $200,000 worth of stock on full margin, assuming you can go 200%. What constitutes a normal size position? Whatever you're comfortable taking right off the bat. You know, if it's, you know, I know Neil talks about if you have 100,000, you can have 5 stocks, and so you allocate 20% to each stock. So you're buying 10,000 the first time. That's a 10% position. I generally like to come in with 20, 30 at least, and sometimes bigger. So, you know, Mellanox has been an interesting stock, and it's almost tradable on a daily basis because it seems to start out the day and have some moves, and it's just continued to move higher from the Bible gap up, and you only had, you know, a little over 3% pullback here, which seemed normal. You got to remember this is a very big gap percentage-wise. I've never seen a stock. In fact, it was almost 50%. I'm sorry, 40%. You know, on the day of earnings after hours, because it got up to like 104, and that's a massive gap up. And so for it to pull back like that for a couple of days seems okay, and it's holding the 10-day moving average. If I owned it, I'd still be sitting with it. So I don't see anything that has to be done necessarily. How does SDRL chart look to you? Well, let's take a look. What is this? Seadrill? Well, this kind of looks like some of the, like OII and some of the oil services. It's probably, that's exactly what it is, right?
Yeah, it's a driller.
Yeah, so I mean, it's coming up the right side of a base, and at some point it needs to go sideways. But you know, these are oils, and oils seem to live in their own little world. Oh, okay. Somebody asking a pocket pivot review. There was none on Allied Communications. Is it reasonable to expect that high volume will return before the end of August, while many institutional traders are on vacation? You know what? I think all of this thing about institutional traders on vacation is a bunch of baloney, because if something has to happen, people are on the desk pretty quick. So I'm not, this idea that everybody's you know, sitting at the beach. I mean, we're almost always sitting at the beach, and I know Dr. K is on perpetual vacation, but you know, well, this volume, more volume comes in September. I think that, you know, what happens is, if you look at it historically, September, October is a time frame where generally you see turns in the market one way or the other. That's not always the case, but that tends to be a critical period for the market one way or the other. And I think that, you know, summertime, yeah, people are on vacation. Individual investors aren't really interested in the market, but I don't think you assume anything. I've seen rallies start in August, so I've seen follow-through days occur in August. I remember specifically one in early August of 1996, and this is right after Elaine Garzarelli. Yeah, what happened to Elaine Garzarelli? She no longer, you don't see her anywhere, but she was a big market maven, a big market timer, and a big analyst name who called the top in 1987, and that was her claim to fame. And then her model went to a big sell signal in late July of 1996, and within, I think, 13 days, we had a follow-through day and had a nice move in the market. So I don't think you can assume anything, or that volume is coming back or isn't coming back. You're still seeing days in the indexes where there's above average volume, and so it's not clear to me necessarily that there's a lack of volume in general. And in fact, if you look at, say, let me go back to a NASDAQ chart. Let's try this. I'm going back to the grayscale chart. Sorry about that, but that's just the way it's got to be. Come on. Nope. Let's just look at a few things. I mean, this is before summer, and look at the moving average of volume. I mean, this is this line down here, okay, along the line. Do you really see it like going down? Yeah, pretty much going flat. So I would say volume is pretty much constant. So go back to.
Yeah, there's plenty of times where the market, you know, there was a huge sell-off in 1996 in June in the markets, and so even though that was the beginning of the summer, I mean, if you had your eye off the ball, you would have lost a lot of money in June, and then yeah, August the markets took right off again in '96. And there's
So I
plenty,
want, you know, I
plenty of
want to
years.
get
So you
bogged
can't
down
don't
in
use
that.
seasonality too much in terms of anything really. I don't seasonality
Yeah.
doesn't really play into our strategy because it can derail you from the task at hand.
And there's no basis to the idea that somehow volume is lower right now in the summertime than it has been in any other time during the year, as I just showed with the moving average of the NASDAQ volume. Someone asked about cores. It's building a base. You get a little pocket pivot, but it's still kind of erratic action. I'd rather see it. I would prefer to see this pocket pivot occur after a little quieter action, so I'm not really that thrilled with it. Somebody says Gil is showing his age. Well, I do turn 53 in about 20 days, everybody, so send me birthday presents. Um, I like weird t-shirts, 2XL though, double extra large. So I like to fit both myself and my wife in my t-shirt, but that's just one of my kinky habits. But anyways, Elaine G, by citing Elaine Garzarelli. How about Bob Farrell? Yeah, Bob Farrell. I remember Bob Farrell when I was at Merrill Lynch. And Robert Prechter. Robert Prechter was the one using wave analysis and saying, and I know all the guys in the Merrill Lynch office in Beverly Hills were using Prechter's analysis in 1991 and saying that we were going into a big Kondratiev period or Kondratiev wave down or however you pronounce that. That was going to be the end of the world. And of course, that was the start of a big secular bull market in 1991. Ralphie Acampora, boy, those are blasts from the past. I love that. Joe Granville, whatever happened to Joe Granville? Lou Smith is another one. Yeah, so I guess did I show my age? I just thought I showed my market knowledge of prior big name market strategists. But anyways, you can see, okay, let's just kind of go over the market before we wrap it up. That's pretty much all we have. We hope to answer all the questions. What happened to my trip here? It should be trip and iSurge. There we go. These are just positions I'm running in different accounts right now. Trip's still kind of weak here. If it breaks in here, I think it's going to lower. That's what I'm watching. iSurge, I think, is potentially could break from here, but we'll see. The market's kind of hanging out, really going nowhere. So, it's kind of blah. And like I said, usually what I'm looking at in the trades I'm talking about in this presentation are short-term, really at best, and I don't really know when we're going to get some sort of sustained move in the market. So, there's a little of this, a little of that, both ways, and I think you can basically take things on a stock-by-stock basis if, in fact, you want to play, because I think cash is just as comfortable a place to be right now as not. Your take, Dr. K, to wrap up?
Yeah, keep your stops tight, like we've been saying, until this back and forth news-driven ping-pong action subsides, and it will. Just be patient in the meantime.
Yeah, I mean, it might be 10 years from now, but it will eventually. No, I'm being cynical. Yeah, hopefully, maybe sooner than we expect. In fact, the more cynical I get, maybe the sooner we are to that point. So let's hope so. Anyways, everybody, thanks for tuning in. Hope you like the screen. I know several comments about the higher resolution screen. This is actually the highest resolution screen on a laptop you will find anywhere. And the sad thing is that Dell doesn't make these anymore. You can't really get this anymore, unfortunately. But if it does work well, and it worked well today, may continue to use this if it looks better on your screen. So let us know. You know where to email us, info@virtueofselfishinvesting.com. We'll talk to you guys later. Take care. Bye-bye.
So long, everyone.